Good afternoon, traders and investors. Will back here with another one, coming to it a Thursday market recap. Hope all of you had a very good day of trading today. And in today's markets, guys, well, what started off as a very nice and bright green day across the markets as a whole quickly eroded into either break even for the SPY and even a percentage loss for the QQQs. At a certain point over the course of the afternoon as well, the markets were up pretty much 1% for the SPY and over 1% for the QQQs respectively. And that all quickly changed as soon as 2 p.m. pretty much rolled around. Take a look at this here, guys. Big drop in the afternoon session. However, there wasn't any news to be had whatsoever. This is just largely due to big tech pulling back from some of its gains and semiconductors giving back all of the gains that they made today, and a lot of the names flipping from green to red. So the market volatility, especially in the names of tech and semiconductors, definitely does continue, but we did have some significant outperformance in our more value-oriented sectors. As you can see, healthcare and financials etching out some beautiful gains for the day. So in today's video, we're going to take a look at a few things together. Number one, I have 3 earnings reports prepared for you guys, and those are going to be Lululemon, ULTA Beauty, and Dollar General, your largest market movers of the day pretty much, and 3 consumer discretionary stocks that are virtually signaling the exact same thing. After that, guys, we're going to go through our major technical analysis rundown of our major market indexes and our big tech names and see whether or not these things are possibly ready to buy the dip on, especially in terms of your big tech names. And no portfolio update for today. We're going to save that for the weekend recap that we do tomorrow after the close. So hopefully you understand that. So now let's move into it right away here, guys. A lot to cover today. SPY pretty much flat on the day. QQ down about 0.15%, but take a look at this rotation here, guys. Yes, you did have a few outperformance gains in terms of Apple and Amazon, Meta and Microsoft too coming in a little bit of green. A lot of software as a service plays were also significantly up in this category and down here as well with Intuit and ServiceNow. But the loss leaders on the day, guys, definitely has to be NVIDIA. NVIDIA paired a lot of its losses from yesterday in the early morning this morning. They actually got back all the way down to only negative 2% and then unfortunately unraveled as the day moved on. But that is pretty much your loss leader for the day. And when NVIDIA has such a large weight in all the indexes, very normal. So if NVIDIA pulls back 4% intraday, you are going to give back a significant amount on the indexes. But even I was surprised in the late afternoon move. Take a look though, guys. The bottom half of the market, your value and defensive oriented names, continue to run away with this market. Currently, financials performing well, healthcare performing well, industrials, very good day for them, and also your consumer defensives. Although a lot of them were red, they did hold up fairly decently, especially in relation to semiconductors and consumer discretionary stocks per se. Take a look at your one-day relative performance, guys. You will see that even better. Most of everything in the green was more oriented to defensives. So real estate, consumer defensives, technology, and communication services led to the downside. On the 1 week relative here, guys, well, everything pretty much in the green except for the three areas that have been pretty much under the gun recently, which is consumer cyclical, obviously with that consumer discretionary spending coming down. A lot of these stocks are just continuously in the mud. Communication services also down. That was largely led to the downside by Google's performance right there. And then, of course, guys, lastly, we have your technology sector, which is still in the red for the week. So definitely not a very good time for them. And I keep saying, guys, there is going to be this continued rotation away from tech names possibly and away from consumer discretionary names and into more value and defensive names that usually perform well, especially when interest rates start coming down, because a lot of those names pay dividends and are already at levels that have been crushed since 2022. So the rotation is well alive in the markets. And as I always say, guys, you just have to follow the money. So moving on in, guys, before we get into more technical analysis right here, let's dive right into our earnings plays. And actually before that, guys, my apologies. We have to go through exactly what happened this morning. Not much change as a whole, guys. We did get the GDP numbers. We were a bit concerned whether or not they were going to revise them to the downside. This is just a preliminary revision. We already got the Q2 GDP numbers pretty much last month. So you can see nice little increase here, 3% in relation to the 2.8 expected, but not much has changed there. And initial jobless claims coming in largely as per the expectation. We did get a glimpse into PCE numbers as well, and they came in under the expectation. The expectation was 2.6% inflation year over year, and we got a preliminary number of 2.5. We will see how the final number comes in tomorrow, but all in all, looking very good here, guys, in terms of the overall state of affairs. Now, I continue to say here, guys, right? This is pretty much a soft landing scenario whereby there is no net crash in the economy right now or in economic data. What we're seeing is a progressive slowdown in the economy, and even your consumer discretionary facing companies, such as the ones we're about to see in earnings, Dollar General, Lululemon, ULTA Beauty, Nike, Starbucks, and the list goes on, right? Yes, they are noting lower and lower year-over-year sales and same-store comparables. However, it is not absolutely crashing. It is a very slow and progressive decline right now, which is perfectly in line with the definition of a soft landing. So yes, I agree with everybody out there. Things are not necessarily getting better, but they're not getting exponentially worse. We are kind of making a linear trajectory towards the worst end, but definitely not the best environment for the markets right now. As a whole, there is still a lot of uncertainty pertaining to the economy and especially the jobs market. So the best we can do is take this one data point at a time and follow the money. Instead of being invested right now, trying to buy the heck out of big tech dips or tech dips as a whole, semiconductor dips as a whole, and consumer discretionary, we should be focusing on more value-oriented names, more defensive-oriented names as well. Give me a very quick second. Sorry about that, guys. Kind of lost my voice right there. That's pretty much everything. So now, let us jump right into our earnings cycle, shall we? So we're going to start it off with a fairly good one, guys, and this is going to be Dollar General. Dollar General down today 32%. And this is nothing new for Dollar General, guys. They have been hit and hit and hit quarter after quarter as their sales continue to dwindle. The big problem with Dollar General is simply the fact that their highest margin items in the store are things that people are just not spending money on right now. Think light articles of clothing, toys, stuff like that. Usually the consumer discretionary items have higher margins for these stores. But apparently, from what Dollar General and Dollar Tree have been telling us over the last year, people don't go there to shop for those things anymore. Maybe they're buying them on Amazon. Maybe they're buying them on Temu, but they're definitely not buying them at Dollar General. Dollar General's most of their sales that have been coming in have kind of been exactly what Wall Street and Target have alluded to as well. A lot of food purchases, a lot of consumer essential purchases, and unfortunately those items, guys, do not have the highest margins. So even though their revenue is slowing, their profits are slowing even more, and they're getting pretty much a double hit in that respect. Let's take a look at some of their numbers, guys, and you will see they were not very good. So Dollar General EPS missed by 5% and a revenue miss by 1.52%. But the damage was not all there. The damage was in the continued negative guidance that the company issued once again. Now let's move on forward, shall we? Let's take a look directly at their earnings call. So net sales increased 4.2%. That is okay, but definitely not the best here, guys. Same-store sales increased only 0.5%, and you'll see from here on out, the numbers get excessively worse. Operating profit decreased 20.6%. That is a very steep decline. Diluted earnings per share decreased 20%. Definitely not going to do any favors for the stock price, guys, when you are reducing your earnings per share. That just means that even though the stock is dropping considerably, it's not getting any cheaper. It's your EPS that's declining. That is the worst case scenario for any company out there. Let's move on further. Here's what the company had to say about this. Despite advancing several of our operational goals and driving positive traffic growth, well, only about 0.5%, right? We are not satisfied with our financial results, including top-line results below our expectations for the quarter. While we believe the softer sales trends are partially attributable to a core customer who feels financially constrained, we know the importance of controlling what we can control. So essentially, guys, they're trying to blame it on the customer slowdown, but then again, they're not trying to blame it on them, saying that there are things that they can control, guys. When I read this, I just read one thing. The company has no more pricing power, guys. And that is the problem when you're already selling discount items. When people stop going there, what are you supposed to do? Are you actually going to reduce even further the prices of products on which you already make very razor thin margins? This is the importance of having margin as a protection and safety net. Take a look at the left side of my big head right here. You will see the net margins for Dollar General. They have never been all of that impressive, right? Usually in the low single-digit numbers. So what are they supposed to do, guys? They definitely cannot increase promotions that much because they'll forfeit pretty much all of their margins. So very troublesome time for Dollar General right now. Moving on further. Gross profit as a percentage of net sales was 30% in the second quarter of 2024 compared to 31.1% in the second quarter of 2023. So unfortunately, guys, gross profit down as well there, a decrease of 1%. The gross profit rate decrease was primarily attributable to increased markdowns, aka promotions, what we were just talking about, increased inventory damages, that's a new one, a greater proportion of sales coming from the consumables category, which I talked about in the introduction, right? And increased shrink. Shrink is a very polite word for saying that they have problems with in-store theft. They've been talking about this now for the past 5-6 quarters in a row, and they are still dealing with those theft issues right now. And now here is why the stock is down 32%. This guidance, guys, is absolutely terrible. I'll just call it as it is, guys. It is very, very poor. Net sales growth in the range of approximately 4.7 to 5.3 compared to the previous guidance of 6% to 6.7%, guys. At the lower end of the range, that is 2% in net sales growth lost. That is a large amount of money, especially for a company that's used to making roughly $40 billion per year, guys. That is a ton of money that they're potentially losing out on by having lower sales guidance, of course. Same-store sales growth in the range of approximately 1 to 1.6% growth compared to its previous expectation in the range of 2 to 2.7, literally slashing their same-store growth estimates by half. That is not very good. And here is the kicker, the one reason why the stock is down so much, because this is the factor that plays the most important role in financial valuation models, the EPS growth rate. That is how you derive your price to earnings ratio. And even though, right, even though the stock may be down a lot, if EPS continues declining, guys, the stock, even though it's declining, it's not getting cheaper, right? This is what you call sometimes a value trap. So diluted EPS in the range of approximately 550 to 620 compared to the estimate of approximately 680 to 755, guys. That is almost 10, right? That's over at this point, over 10% reduction, almost closer to about 20%, right? If we were just to take the lower end of the ranges right here, 550 divided by 680, right? That is 20%, almost 20% reduction in EPS. That is not going to do it, guys. That's why the stock is down over 20%, right? Very, very bad, poor performance for Dollar General. Unfortunately, we're not going to go through their numbers. Just understand that they still do have a large problem with merchandise inventories up here, right? They've been trying to get rid of some of these inventories, guys, but they're just not able to wind it down quickly enough. A lot of other companies have been having this problem. The most famous one has been Nike, right? So let's get into the valuation. Even though the stock is down tremendously today and tremendously down from its all-time highs, now down 68%. Is it a good deal right now? Well, let's have a look, right? So in terms of the revenue growth for the next couple of years, 5.4%. That is down significantly from its traditional 7 to 8%, excuse me. EPS growth of about 10% per year. That is still fairly generous in my humble opinion. If we take a look down here, you will see that yes, EPS is going to get crushed this year. They're supposed to be expanding in the next couple of years, guys, but I do expect that the growth rates for these EPS numbers will be revised in the near-term future, and revenue growth is positive, but definitely slowing as well. So let's take a look here. Forward PE at $84 is about a 14.3. Now, 14.3 may not seem high, but when you only have EPS growth of 10% per year, right? A PEG ratio of about 1.43. It's not even that close to 1, guys, to be a crazy good deal out there, right? Now, the one thing that is positive for them is that they have been buying back a ton of shares in the company's history. However, as you can see, they have paused all buybacks over the last 4 quarters. And this was also available in their, if I just do share repurchases right here, right? So no purchases of, no buybacks of the stock in the entire last quarter as well. They still have 1.4 billion in available cash. I think they're holding on. Well, they have that approved under the program. It doesn't mean that they can do it, right? It doesn't mean they have to do it. If they want to do it, they can. If not, they can allocate the cash elsewhere. But that 1.4 would be very, very welcome for the stock here, guys, right? 1.4 divided by their market cap right now, that would be roughly 7.5% of shares outstanding. That could give their share price a nice little backstop for all of this bleeding. If I was the company, guys, if I didn't need the cash, if I wasn't in risk of falling behind on debt payments, perhaps they should probably start buying back shares, but there must be a reason why they're not doing it. It's probably because they're actually nervous about their financials. So all in all, guys, the company right now is not even very cheap as a whole, right? We can go take a look at some of their historical ratios as well, right? Take a look at their historical price to earnings ratio. Right now, the forward base is about a 14, but on a trailing basis, as you can see, they're not really cheap right now, right? The lowest on a forward basis, yes, but on a trailing basis, not even so cheap right now, even at about $84. So it's not as if you're getting a generational discount on Dollar General in relation to their earnings growth, right? So unfortunately for me, guys, Dollar General is going to be a pass. You might remember I added this one in the dumpster dive portfolio, right, where I only bought 50 bucks of it just a few weeks ago here, right now at about the 120 mark. And this is why, guys, I refuse to go heavier in some of these beaten down companies until we see some quarter over quarter improvements and until we can be confident that all of this damage is now behind us and that the company is on a better path moving forward. But I do not see that just yet from Dollar General. So that's pretty much everything from Dollar General, guys. I would not touch it, which is why I'm not even giving some technical analysis levels right now, guys. I'm just not touching this company. It is literally a falling knife right now. So we need to establish some support levels before bottoming out right here. The next big area is coming up 76 all the way down to about $70, guys. That is literally the next area of big support from all the way back in 2017. Now let's get into company number 2, guys, and we will see that the damage simply continues, unfortunately, for these companies. So Lululemon pretty much up 5.36%, but the earnings numbers were not good. Now, Lululemon has had a very, very volatile after-hours session. They're probably giving their earnings call right now, trying to be as optimistic as possible, right? But when the numbers were released, this stock was down almost 10%. And with good reason, guys, the numbers were not very good. And Lululemon is a perfect example of why, especially in the fashion industry, guys, I'm very hesitant to invest in any company whatsoever. I have never played Abercrombie & Fitch. I've never really played Lululemon that much as well. I can pretty much count on my hands the amount of times that I have played Lululemon. It's just because the company does not have, in my humble opinion, a noteworthy competitive advantage that is not able to be replicated by its competition. As a matter of fact, one of the main things that's been affecting Lululemon in the past 2 years is competition from new brands, especially online brands that start on TikTok and Instagram, right? And unfortunately for them, guys, they just have no moat. We have to say it how it is, right? Do they have good quality products? Yes, but that is not a moat, guys. If people can replicate your products and undercut you, well, unfortunately, that is synonymous with not having a competitive advantage and not having a specific moat, right? They were a very, very solid company. They pioneered the athleisure fashion trend as a whole, and it really took off a few years prior to the pandemic. But ever since, we've kind of been topping out right here, since competitors have been coming on into the space since the early portions of 2021 and 2022, you can see Lululemon is very, very tough for them to start protecting some of their share price action. As a matter of fact, if you would have invested in this company 4 years ago, right now, you would be unfortunately down, right? So take a look at their numbers here, guys. Lululemon EPS beat by about 7.47%. That is on lowered guidance. And they did have a nice revenue miss here by, well, nice. They did have unfortunate, I meant nice for here and bad for there. Bad revenue miss here by about 1.52%. So let us dive into the numbers for Lululemon, shall we? So Lululemon cuts guidance, misses sales estimates after botched product launch. Not the best headline as a whole, right? So moving on, Lululemon lowered its guidance and posted its first revenue miss in more than 2 years on Thursday after it botched a highly anticipated product launch and growth slowed in the Americas. The company now expects full-year revenue to be between 10.38 and 10.48, down from a previous range of 10.7 billion and 10.8 billion. So about a 2% miss on the revenue guidance for the remainder of the year. EPS as well was about a 2% miss on guidance, 13.95 to 14.15. So now down from a previous guidance of 14.27 to 14.47. So miss on guidance on the top line and miss on guidance on the bottom line. Let's continue. Lululemon also missed expectations on comparable sales, which grew 2%. Well behind the estimates of 5.9, comparable sales in the Americas fell 3%. The trend doesn't appear poised to improve in the current quarter. Lululemon said it expects sales to grow 6 to 7%, worse than the 9.2% growth that analysts had expected. So they're literally missing on everything right now, guys. Very unfortunate for them. During the quarter, Lulu posted its Breeze Through leggings, launched in early July, after it received a wave of complaints about the product's unflattering fit. The botched launch came after the company struggled with a number of other self-inflicted issues with its assortment, including not having the right colors and sizes that its core customers desired. This we brought up last earnings cycle, guys, how the CEO was putting a lot of emphasis that they missed their numbers because there was one certain style in which people wanted certain sizes and colors and they just didn't have them. And in my head, I was thinking, well, if that's all it takes to severely impact your numbers, maybe there's something larger at play here, right? So, like other retailers that are seeing low demand slow, Lululemon appears focused on what's within its control, operations and efficiency. While the sales picture during the quarter was rougher than expected, Lulu's profits came in higher than anticipated, the only positive point of the entire data set. Gross profit grew 9%, while its gross margin grew 0.8 percentage points to 59.6, better than the 57.7 that analysts had expected. Its operating margin and operating income also increased. So at least the company is showing veteran discipline in terms of cost control, right? The last thing you want to do as a big business is when revenues are slowing, you keep the costs the same or keep increasing costs, right? That is a recipe to erode your margins and really annoy shareholders big time, right? So the fact that they acknowledge that there is underlying problems in the economy right now, in the consumer, they understand there's work to be done, and they are having active cost control right now, that is the best thing that they can do as a company, right? But still, they're going to have to offset eventually some of this weakened demand by promotions, and that in turn will affect their margins. So let's move into the valuation for Lululemon right now. So in terms of the valuation here, guys, right? Well, the company, let's get into some of their, let's get into a few of the things that makes Lululemon pretty good, right? Number one is the fact that they don't have much debt. As you can see, they do bring in a decent amount of free cash flow per year, and they have well enough cash on the balance sheet to pay off any long-term outstanding debt. Now, their margins as well, their margins are not that bad. Over the past couple of quarters, they have been slightly inconsistent, but this company is used to having about mid-teens percentage points. I wouldn't be surprised if that is tested over the next few quarters if they have to increase sales promotions to keep customers coming into the door and purchasing online. In terms of the EPS, well, you can see they've kind of revised EPS to the downside now, but we do still have EPS growth supposedly over the next foreseeable future, and we do still have revenue growth over the next few years as well. But both of these things are slowing, right? They are increasing, but they're increasing at a slightly slower pace. That is what's been afflicting the company so far. So the company right now is down significantly off the all-time highs, guys, down about 50%. Just year to date, the company is down 49%. Very, very, very unfortunate time to be a Lululemon shareholder right now. Take a look at their profit margins. So their profit margins are okay. Got to give them that. They've been able to maintain gross profit margins decently. Operating margins, they've been able to maintain those in the low 20% range. Not as high as it used to be for the company, but still somewhat decent, right? There's no major red flags. They've done a good job coming back from the lows of 23, that's for sure. And their net margins as well, as I was saying, mid-teens, roughly in line with the higher end of the company's historical average. But this is Lululemon's margins to lose, right? We have to be very, very careful of this. So just keep an eye on that. And in terms of share buybacks as well, at least they do a very good job of buying back their shares. You can see that they are continuing to buy back shares even throughout the decline of the stock, which is the best case scenario for the company, in my opinion. In terms of the valuation here, guys, well, their forward PEG PE ratio at 260 right now is about an 18.5. 18.5 in relation to the history of the company, guys, is quite low, admittedly, right? So let's take a look right here. You can see their price to earnings trailing right now for the past is about a 21. On a forward basis, it's about an 18.5. You usually don't see Lululemon trading at an 18.5, guys. As a matter of fact, they haven't really traded at an 18.5 in the company's history since going public. So you could say that they are slightly cheap in terms of a PE ratio. What the problem is with that is the forward peg. Because their EPS growth rate has been slowing, it doesn't much improve their PEG ratio, right? Now only about a 1.68. 1.68 is okay, in my humble opinion. However, guys, even though the valuation does appear to be quite juicy and attractive in relation to the company's history, we have to understand what is affecting the company right now. And this, for me, has to be aspect number one, right? Unfortunately, right, last quarter, they had one of these problems. They had the problem that they had a problem with assortment, right colors and sizes. Now they have a problem with a botched launch. It just goes to show how hard it is, guys, to maintain your industry leader status when you are a fashion brand. You will continuously get challenged by the competition. And usually people with fashion brands are very, very picky. And if they have one bad experience, they may simply never come back, right? So unfortunately, this is the main thing that's plaguing Lululemon and is the one thing that's kept me away from the company. Now, in terms of a trade here, guys, a swing trade, well, there is a current swing trade available, right? You would have to pretty much, if you do want to go for the recovery story of the stock, even though I don't personally assume that the stock is now yet bottomed. I know it looks crushed, guys, But keep in mind, this is possibly just the start of a larger consumer slowdown. So in my humble opinion, it's very, very tough to trade this one. As we can see, we do not have a defined weekly uptrend as of yet. But if we do start retracing back into this location, right, maybe in the 250 range, well, at that point, you'd be looking for possibly this following turnaround setup, right? We'd have to be waiting for the daily downtrend to come to an end, daily uptrend to be formed. As soon as we see a classic daily uptrend formation right now, that is when we could possibly enter for a weekly momentum trade right there. Our stops would unfortunately have to go way below here, 225. So right now, there is not much of an attractive trade, right? We really need to see it come down a bit more. If it can come back down below 250, then we can maybe have a $25 stop loss. And at that point, you'd probably be targeting these weekly highs just above us right there at about the 312 level. But unfortunately, you have to get through all of this massive resistance first, right? So I don't even like it here, guys. I'm forcefully trying to derive a setup for you, but I will not be touching this one as well. My two favorite companies in fashion, because they have an actual solid business model that's tough to be replicated, right? And overall appreciated by the consumer. TJX is number one. Extremely efficient business, guys. Way more efficient than Lululemon, as a matter of fact. And the other company, right, that has a tremendous moat and a dominance over the entire market in terms of what they do is Louis Vuitton. Those are the only two fashion brands that I have in my, or that I consider for any form of long-term portfolio, but even for swing trading, guys, because we know these things can shift around quickly. And now the last company we're going to be covering here, guys, is ULTA Beauty. So ULTA Beauty as well, down about 6.67% in the after hours, not responding too well to their earnings. And even in spite of Warren Buffett buying the company here, guys, the company was just not able to keep it up. Now down, as I said, roughly 7% in the after hours. So let's have a look at what exactly is plaguing ULTA Beauty. And ULTA Beauty is being given a run. Just as a preface to this, right? The reason that ULTA Beauty is somewhat down here today as well, there's been a lot of talk about increased competition for ULTA Beauty from someone like Sephora, right? And who is Sephora? Obviously, everybody knows them as a company, right? But do you guys know who owns Sephora? Well, I'll give you a little hint. It's the company we just saw, right? Louis Vuitton. So not only is Louis Vuitton, because it's a conglomerate of 86 different luxury brands, not only does it compete with Lululemon, right? Because it's more on the higher end of fashion retail. So it does compete, although they don't sell exactly the same things, it is still a fashion retailer, right? So not only does Louis Vuitton compete indirectly and somewhat directly with a brand like Lululemon, but they also have Sephora, which is the top leading company in the world for beauty products in relation to measured by Gen Z. Take a look at this right here. Female teens' favorite beauty shopping destinations for the fall of 2023. We're going to wait for the survey that comes out this year, but this was from 2023. Sephora leading the charge, ULTA Beauty in number 2, and then you obviously have another set of retailers down here, which these do carry products that are also sold by Sephora and ULTA Beauty and by Elf Beauty, stuff like that as well. But you can see clear winner is Sephora. And what does Sephora have that ULTA Beauty does not? They have international exposure. So ULTA Beauty for now is simply only in the United States. Sephora is now a worldwide brand. So goes to show you guys the importance of having a moat. This is just one of Louis Vuitton's many companies, and they are dominating ULTA Beauty, and that's ULTA Beauty's only line of business, right? So moving on in, don't want to take too much away from ULTA Beauty, of course. It is at a decent valuation right now. Let's get into it. So moving into it, down on EPS. They missed on EPS by about 3%, missed on revenue by about 2.3% as well. Let's dive into the nuts and bolts of the earnings report, shall we? So let's dive into it. ULTA misses Wall Street expectations, trims guidance after quarterly sales decline. Same pretty much thing as Lululemon and same thing as Dollar General. Even though they are all in different industries, consumer slowdown is broad-based at this point. Let's move into it. The company fell short of second quarter expectations and trimmed its full year guidance after a decline in same-store sales during the most recent period. It was the company's first earnings per share miss since May of 2020, 4 years, guys, and first revenue miss since December of 2020. Comparable sales for the second quarter fell 1.2%, compared with an 8% increase a year earlier, and well below the 1.2% growth that the analyst had expected. So they were expecting to grow comparable store sales, and unfortunately they lost 1.2%. Now, while we are encouraged, here's what the CEO had to say, Dave Kimball, while we are encouraged by many positive indicators across our business, our second quarter performance did not meet our expectations, driven primarily by a decline in comparable store sales. We are clear about the factors that adversely impacted our store performance. economic consumer slowdown. And we have actions underway to address the trends. Promotions, right? Loss of pricing power. The company now forecasts full-year same-store sales in a range of flat to 2%, compared with prior guidance of 2 to 3% growth. Now, let's move on. Shares of ULTA have been suffering since CEO Dave Kimball warned of cooling beauty demand at an investor conference back in April. Kimball said although a pullback was expected, it had hit the company a bit earlier and a bit bigger than anticipated. As a matter of fact, this is not something that other beauty retailer Elf Beauty has said recently, and even in Louis Vuitton's earnings, which we covered on the channel, this is not something that Sephora said either, right? Sephora was still relatively on trend, but then again, even though their sales in North America were slightly slower, the international revenues for Sephora largely made up for that, which is something that ULTA Beauty does not have. During the company's first quarter earnings call in May, Kimball outlined plans to boost sales that span 5 key areas: product assortment, brand social relevance, enhancing the consumer digital experience, boosting the loyalty program, and evolving the company's promotional levers. Why I read this to you guys is because this company understands that there's a problem at hand. They already have a business plan to address these problems and are trying to work on it as best as they can here, guys, right? They're trying to protect profits. Same thing as Lululemon. These are very well-established companies with very good management teams. They know the job at hand. They know what needs to be done. It's all about cost control, promotions, and marketing to somewhat stimulate demand artificially while not giving back too much in the margins. Margin compression during a consumer economic slowdown is quite normal, but you can control to somewhat extent, you can control the degree to which you get hit in those margins, right? So the company is doing the best it can with its cards at hand. So moving on in to our valuation here, guys, for ULTA Beauty. So obviously we know that ULTA Beauty is now down significantly from their all-time high, roughly about 35%. And we know that Warren Buffett opened a position somewhere in this area right here. So we know that for a majority of his holdings that he's probably underwater right now on this stock. So moving into the valuation, let's see why potentially Warren Buffett bought it. So let's move into their business in terms of their balance sheet. So let's take a look at their balance sheet. Not really a problem. Yes, they do have about $2 billion worth of debt here, guys, but the company brings in roughly $12 billion of revenue per year. They bring in a decent amount of free cash flow per year, about $1 billion, and they have a decent amount of cash and cash equivalents on hand. So although they do have more debt than cash and free cash flow, I don't think it's an unmanageable amount. Their balance sheet looks relatively healthy to me. In terms of their forecast. So as you can see, 2024 is going to be a roughly flat year for them, but they should be coming back to EPS growth in 2025, 26, and 2027. We will see, guys, the revisions down for possibly 2025 in next quarter as well. Moving on to revenue. Revenue also said to be expanding, but definitely not expanding at the rate we had here, 21 through 2023, right? More of a tapered growth line for ULTA Beauty right now. That gives them a revenue growth rate per year of about 4.9% for the next couple of years. EPS growth rate of about 8.1%. This is down from closer to 10%, so definitely slowing there as well, and slowing on revenue down from about 6-7% too. So moving on in, guys, their price to earnings ratio at $340 right now, which is their price in the after hours, is about a 14.75. This number right here and this number right here is why Warren Buffett bought the stock. So you remember what we did on Lululemon? We saw their price to earnings ratio was some of the lowest that it had in the company's prior history. ULTA Beauty, largely the same. Take a look at this PE ratio on a trailing basis, let alone a forward basis, right? Forward basis is roughly around the same thing, 14.75. On a trailing basis, though, 14 price to earnings ratio, pretty much lower than it's ever been in the company's history. So there is value at these current levels here, guys, because the earnings per share, although it's come slightly down, it is not crashing, right? So there is still a lot of value to be had in this company as a whole. The company also boosts its EPS artificially by doing buybacks. As you can see, clear buyback trend since the start of 2016. Very nice curve in terms of just buying back a bunch of shares and improving that EPS in an artificial fashion. And then the second reason that Warren Buffett bought this company most likely is the free cash flow yield. Free cash flow yields, Warren Buffett always looks for between 3.5% to about 5% in free cash flow yield. So at 5.1%, that is usually very good, right? Usually for more established companies like ULTA Beauty, like Microsoft, companies that have been around for at least about 20 years time, 15, 20 years, a free cash flow yield of about 3.5 to 5% is quite good. Now, obviously, the lower the stock goes, the higher this ratio increases, right? So when it's above 5%, it's usually a good deal. Couple that with the fact that we are at a relatively low, well, actually historical low price to earnings ratio, both trailing and forward. That is why there is some definite value in this company, and most likely why Warren Buffett picked up some shares. Now, if you want to trade this one with Buffett, obviously, guys, he is a much better longer-term investor than me, right? You know, his returns are some of the best in the game, and he's been doing it since the 1960s pretty much. So there's nothing I can say to critique Warren Buffett's decision. It is good value down here, right? And I don't doubt that ULTA Beauty is going to be able to recover over the medium to long term. But is this a company that I want to own in the next 5 to 10 years? Well, arguably, they're a very good retailer, but do they actually have a moat? Are they a worldwide known company, right? With international exposure and very difficult business model to replicate? To be quite frank with you, probably not, right? So probably Warren Buffett, for him, this one is more of a trade. We know that Warren Buffett has two styles of investments that he makes. One are companies like Coca-Cola, insurance companies, some of the banks that he's held, some of the petroleum companies he's held, a company like Apple too. A lot of these companies, he holds them from 5 to 10 to 15 to 20 years type of thing, right? And just lets them play out. Buy a good company at a great price, right? So now, or buy a great company at a good price, right? But now there are also some other positions that Warren Buffett does take some time that are more recovery style trades. You may see him in them for maybe 1, 2, 2.5, up to 3 years, and then he starts slowly getting out of the position. I think that's more one of those for him, right? But we are coming up onto a very large, I mean, we're almost below, we're netly below this previous area of support. Now we're really coming down into the lower bound right here. I would be interested in this company, guys, but since I don't believe that the consumer slowdown has really hit the peak of media headlines and the peak of profit margin crush for these companies, I'll be targeting the lower bound of support down here. Call me cheap, right? Call me too patient, call me too conservative, but this is just where I want to play this company, right? I do have other retailers in my portfolio. Don't worry about me, right? If I wanted to play this company specifically, I'm going to need a better price. I'm going to need to find it at least down, possibly into the $320 all the way down to roughly $300 range. That is where I would consider playing this company, because in my humble opinion, the valuations down there get even better, and I don't think we're quite out of the woods just yet for the consumer discretionary spending slowdown. So that's pretty much everything we had for our earnings today. Hopefully you appreciated those recaps. Now, moving on into our technical analysis portion of the video, let's jump right into the SPY. So the SPY pretty much has been doing a whole lot of absolute nothing. As you can see, they made an attempt to break the high of the range, but just unfortunately failed. So now we are kind of stuck on the SPY, right? Either with the higher bound or the lower bound. The one positive thing is that after such a volatile move to the upside, right, we're consolidating at the top end of the range. This is usually a very good thing. The last thing you want to see, guys, is the bears pull back a ton and then we consolidate over here, right? It doesn't look the best for a continuation of the V-shaped recovery. But if you have a massive rally and hesitate over here, consolidate over here, right, the bulls are trying to keep their momentum for an all-time high push alive. So we'll see if they can get it done. One thing's for sure, if they do break the top end of the range here, guys, daily uptrend is now newly underway, and we target the all-time high area of resistance, 565. However, if we break both of these levels to the downside, that will be an official daily downtrend under motion, and then we will look at potentially some further weekly consolidation. Weekly consolidation, in my opinion, could bring us down as low as about 546 all the way down to about 538. This location right here. Once again, we are trying to two-step this recovery process. So in the event we find ourselves at a double top on the SPY, just remember we can have a few bullish patterns right here. Cup and handle would be one of them. So in the event we pull back to the 12 EMA and this green box of support, there's most likely going to be some bulls sitting there, and we could have some very good opportunities to be buying the dip at that point, right? As of now, though, just pretty much stuck in a tightening range. It is very good, however, that we have some overall broad market performance, right? No single sector is contributing to lifting the SPY as it once was the case a few months ago, where it was only these guys doing all of the work and the rest of the market was doing nothing. Now, at least we have a bit better breadth. Now, let's get into QQQ. Give me a very brief second. And let's get into the Q. So QQQ is down about 0.15%. As you can see, not the same setup as the SPY, right? The QQQs are in a confirmed daily downtrend at this point, and the daily downtrend is simply continuing. So where can we possibly continue this daily downtrend into, guys? Well, we're getting very close to my target zone. 464 all the way down to about 456. We are possibly looking out for the setup for an inverse head and shoulders and possibly rally thereafter. So one of two things is going to happen here, guys. Either we're going to have to find some short-term oversold conditions and then eventually get an engulfing move and reset the daily, right? Or the bulls can always choose to do it from here on the daily. For that, guys, we need to see a break of today's high. They made an attempt at it, right? They really made an attempt at trying to reverse this, give an engulfing move and reset into a possible daily uptrend. Could not get the job done. So I will be very patient right here, still expecting some further weekly consolidation potentially. So that consolidation could maybe take us, as I said, into this green box, 464 down to about 455. That would be an adequate area. The bulls just need to gather a little bit more steam before making a new weekly trend change attempt. So all in all, the QQQs not looking too bad. I wouldn't say that the rally is considerably done right now, right? Gorgeous move, and we have not taken back too much of the move as of yet. If anything, maybe just looking for that weekly higher low for possible further trend continuation. I will keep my eyes peeled and we will take this one day at a time. Let the market come to us, guys. And trust me, there is definitely some deals in big tech right now. We're going to get into that in a bit later into the video. Moving on to XLF right now. XLF really carrying the entire weight of the SPY here today. Fantastic job by then. This was pretty much led to the upside by the two names that I've been speaking the most about on the channel. Visa, you remember, guys, I've been talking about it this entire time that it was down here. Tremendous value. Very happy that a few members in our private Discord were able to get this trade down here, and everybody now is having tremendous gains. So congratulations to all of you, whether you're in the Discord or not, whether you just watch the channel. Congratulations to all of you who were willing to take this trade. Same thing for MasterCard. We've been talking about MasterCard this entire time since the months of June and July, and now we get to collect all of those juicy profits on such gorgeous companies. So financials looking very good. Now daily uptrend simply continues at this point. As soon as this move tops out, going to be looking for a daily higher low. Anything above 43.60, looking for that daily higher low for a possible further trend continuation. Where could we maybe pull back into, guys? This area of confluence, 44, where the moving average of 12 EMA is sitting right there as well. So a little bit of a breakout, retest, and possibly revisit could be an opportunity. In the event we fail and roll over on the daily, just understand the weekly is under our control. Beautiful weekly uptrend would just be looking for a weekly higher low for possible further trend continuation later after rate cuts. Moving on to XLV right now. XLV also looking very healthy, 0.21% to the upside, guys. This just does not stop, right? Just when you expect it might have a little bit of a rollover consolidation, nope, it just keeps going for even more. So this one is looking absolutely fantastic right now. Daily higher lows were previously right there. Now that we've put in the new highs, we can argue that this whole area right there is the sector of the new daily higher lows. I'll put it right about here at about 155. So at this point, continuation is underway. If we get a little bit of a pullback, anything above 155, looking for a daily higher low for possible continuation. However, if the bulls get a little bit tired, which it seems that they may just be getting a tiny little bit tired, well then, if we do roll over this, guys, set up for the daily downtrend, just once again understand that we have tons of space on the weekly. Anything at this point above, anything above right here, 145.60, looking for that weekly higher low for possible further trend continuation. To be opening further positions in healthcare myself, guys, I will be waiting for maybe a retest of this location. There's a lot of names in healthcare right now that are pushing all-time highs or breaking beyond all-time highs right now, and I just do not want to chase this sector, even though it is outperforming. That's just not how I operate, and you guys should know that by now. If anything, we're waiting for the breakout, retest, and run trades because the bulls control all of the higher time frames, especially the monthly right now. Moving into SMH right now, semiconductors not having the best day at all. This index was actually green today by over 1% and gave it all back and more. So unfortunately for semiconductors right now, your daily downtrend simply continues to be underway right now. So at this point, guys, we are going to start challenging this lower area of support, 238 down to about 224, right? Very unfortunate sell-off by semiconductors, led to the downside, of course, by NVIDIA. Now, keep an eye on the weekly, guys. As long as this daily downtrend continues like this, we're going to keep an eye on this weekly retracement size. So take a look. The size of the bounce was fairly decent right there, right? It was about a 618 bounce, 618 bounce. And now the bulls are looking to do the following. Oops, my bad. The bulls are looking to do the following, looking to reset this into a weekly higher low for possible further trend continuation. So one thing's for sure, I do not want to see them lose 225. Cannot lose this prior all-time high area of, well, this used to be, 2 iterations back of the all-time high, right? Cannot lose this prior area of support. If they lose it, guys, the bears will take back way too much, and you open the door for either the flush or simply the 2-step rollover as well. So the 225 area, in my opinion, is the cannot lose area of support for the bulls. So we will take this one day at a time. I'm still very interested in playing a lot of semiconductor names out there at very attractive levels. Micron is one of them. Micron, I love playing Micron. At this point, we're going to try to play it in the mid 80s for some short puts. Yes, I understand we are in a big weekly downtrend right now, but I like the valuation on Micron at these lower levels. And especially if we get assigned at the mid 80s, the drawdown, in my opinion, is not that bad, maybe all the way towards the mid 70s before we get into some really big levels of support at that point. So Micron is one, TSM is another one that in the event we drop back to the 150 location, I definitely want to start playing that one too. If we drop back on ASML as well, ASML, any retest of this 850 and below, I'm going to be willing to play ASML. Tremendous location of prior all-time high resistance, should be newfound support for the stock. So 850 all the way down to about $800, even sub 800. This whole about $100 range is a nice juicy area to be picking up some ASML stock. A few other ones that we're going to be looking at, of course, we cover them later anyways, but NVIDIA, I like it, right? 105 down to 95, that's my desired target location for NVIDIA. AMD as well, AMD down to, 135, then on 123. Not going to touch ARM, to be quite honest with you guys. I just do not like the valuation at this point, even at the lower 125s. Just don't like the valuation. I love the company, but I do not like the valuation in this current market right now, where semiconductors are slightly out of favor. And the other one that I'm not going to play here, guys, is SMCI. I know SMCI is absolutely crushed right now, but I just do not think that this company has a competitive advantage or a significant moat, even though their valuation is significantly below the industry averages right now. I just don't think this company is a good long-term bet and can just continue to get eroded over the short term, guys, especially since other companies have now been coming out and saying because SMCI is not giving enough output to the industry, they are searching for competitors in something like an HPQ or maybe even Dell, and even Google is starting to make its own server racks. So this company's competitive lead that they've had for now the past 2 years is very quickly eroding. So that's why I'm not going to play SMCI, unfortunately. In my humble opinion, I hate to say this, guys, I really do think that this company has pretty much topped out for possibly years and years at this point. So moving down further, guys, let's jump into our Dow Jones to wrap it up. So the Dow Jones right here, Dow Jones up about 0.59%. Pretty good performance by the Dow Jones, all things considered, right? While the rest of the markets pulled back, this one was fine. So the Dow Jones not looking too bad right here. Beautiful daily uptrend as of currently. Still just hunting for the all-time high push follow through, which we got a little bit of today. In the event, guys, we lose today, yesterday's lows, that would be losing the daily uptrend. We might just be looking for some consolidation. Why? Well, because the Dow Jones has ran 4 big green weeks in a row. In the event we do start consolidating, guys, just keep in mind, looking for the weekly higher low for possible trend continuation. So the Dow Jones is looking very good right now, guys. Even you got a nice weekly MACD cross. So we may not consolidate by too much before really putting in an extra leg higher. Just again, once goes to show, guys, the rotation from tech to value is really omnipresent right now in the marketplace. Now, moving on further here, guys, let's move into big tech names, shall we? So moving on to Apple. Apple down about 0.59%. Or sorry, that's AMD. Apple down, Apple up, of course, Apple down, right? I knew there was something wrong when I started that sentence if Apple was actually down for a change in the past month of trading. Now moving into Apple up about 1.46%, handling it better than most. And this is what we were saying, right? This is exactly what the S&P was doing. You guys remember that chart from the S&P, right? Exact same setup. When you have a consolidation range at the top end of a move, usually the move does trigger a lean or a bias to be bullish, right? So moving on in, that is exactly what happened on Apple. As you can see, break to the upside. So now Apple back into a nice daily uptrend pretty much as soon as this move is topped out, because maybe they last for more than one day, targeting all-time high resistance of 236. As soon as this move tops out, looking for a daily higher low for possible further trend continuation. I would like to see Apple put a little bit more space between us and this resistance that we just broke through, right? A couple more candles, then maybe pull back into it, use it as support. That will be the best or most pretty price action. The one thing you don't want to see, guys, is look back below and break down below this range. That would all but guarantee that we're heading into big weekly consolidation. That would probably take us down into the 220 to about 215 levels, which is what I'm waiting for on Apple. Very tough for me to play it up here even for a breakout here, guys, it's just the valuation concerns for me on Apple are just too much for me to commit any sizable position to Apple. I mean, of course, we can make some, 1, 2, 3 day swing trades all the way through all-time highs with the stops below here and our targets all the way up here. But then again, it's kind of a one-to-one trade at the current time, right? Just giving you guys my trade logic. Our stop loss is right there, and the take profit is at the all-time highs. As you can possibly see from this chart right here, the risk to reward ratio is a 1.12. It's almost par. I'm not in the business of taking those trades, guys, especially close to the all-time highs, which is why Apple need to be a little bit more patient with it. Yes, the bulls are in complete control right now, completely agree, but I need some better prices if I'm to play Apple. I would like to see at least a weekly revisit of these lower levels down here, which may free up some lower strikes for all of us who are writing options below the 207, 205, preferably as low as 200, but we might not get it for a little bit of a while. But Apple right now, looking pretty good, right? This is where you have 3 different ratings, right? You have a buy, you have a hold, and you have a sell. For me, Apple right now is just a hold. So moving into AMD, give me another quick second. AMD down about 0.59% here today, guys. Not the best day for AMD. At one point, they were green, considerably green, right? Over about 1% in the morning, and then sacrificed all of those gains. So unfortunately, AMD's consolidation at this point simply continues after getting rejected by our big zone of resistance here, 162 down about 154. Bulls could not keep it up. Daily downtrend is now underway, and we are probably looking to move into this zone of support, which currently is about 142 all the way down to about 127. Fairly wide range, I know, but then again, we do have a first line of defense that's sitting right here at about the 137.5. Big resistance stopped the market temporarily, and then we had earnings and blasted through it. You can see how often this level was resistance too, right? So very much a challenge level for now. So that 137 is going to be the next area of support. I mean, at this point, guys, we are starting to give back a little bit much of the weekly move. We'd like to see AMD really start kicking in for defense around that 137, right? Because we know the size of the bounce, although good at a 618 retracement, is not the best, right? It's not an 80%. We didn't make it above this area of resistance to really be able to use it as support either, right? So now the bulls will have to play very good defense down here if we do start retesting this 137, 135 range. That being said, the further we start dropping on AMD, the better prices we unlock if we're selling options. I will be interested over the next few weeks of selling options, possibly below the $130 mark if we can get that pricing. That is where the valuation of AMD is really a no-brainer in my humble opinion. Just keep in mind with AMD, guys, I know it kind of sucks. I know it's kind of done nothing since the month of February pretty much. And now we've even given back, a lot of the year-to-date gains. But just keep in mind, guys, the true growth for this company, as I've said a few times on the channel so far, comes in 2025. So if you're invested in this company because you think there'll be a second close competitor to NVIDIA's data center ramp, well, you have to give that line of business a chance to actually scale and ramp. And that scale and ramp comes in 2025. You can obviously see the big impact it's going to have on EPS and the big impact it's also going to have on their revenues. So if we're a long-term investor and our thesis is data center competition to NVIDIA, well, we need to give this stock enough time to really, fulfill at least that thesis and see how it plays out, right? And that's going to be 2025 and 2026. The valuation right now, 145, very, very cheap in light of that future growth. So I like it. Moving on to Amazon right now. Amazon up about 0.77%. Another good day for Amazon. So in this case, guys, Amazon is still looking for the same thing, right? Gorgeous daily move up, looking for the daily higher lows, and we're trying to possibly establish it right here at the 200-day moving average. Now, keep in mind, guys, in the event we are not able to push this daily uptrend high into possibly this earnings candle right here, the 185, and maybe we just roll over because big tech remains weak. Just keep in mind, what are we looking for here, guys? Looking for a weekly higher low setup for possible weekly trend recapture by the bulls. Take a look at this. We did have a very good bounce, a 618 retracement. It does give the bulls a chance to be able to revert this on the weekly, right? Keep in mind Amazon as well. So this box somehow moved, but keep in mind we are in a very, very big, hotly contested area of support right now, which is pretty much your 174 down to about 160. So I really, really like Amazon down here in the lower 160 range. In the event we continue falling, guys, this will be a location where I'll be heavily looking into leap call contracts on Amazon. If anything, a consumer discretionary spending recession may just lead people to shop even more for promotional items on Amazon. Their Amazon video segment is doing very well. AWS continues to be a leader in the industry with very, very strong cloud growth. And Amazon's free cash flow and profit margins are going to be the best they've ever been in the company's history this year and next year moving forward too. So everything is a green light for me on this company. I'm just trying to be a little bit more greedy with my pricing here, guys, which is why I say if we revisit probably the mid 165s, I'll probably be looking for some short dated call options, maybe 3-4 months out, but I'll probably even be shopping for some 24-month, maybe a year and a half, 24-month call options on this stock too. I love this level, great company as a whole. Moving on to Google. So Google also not looking too bad today, down about 0.67%. Now, Google has not had the best bounce amongst all of their peers. Take a look at this weekly bounce, right? The weekly bounce on Google was shameful, to say the least, right? We expect better from Google, but unfortunately they've been bogged down by a few Department of Justice headlines and stuff like that. So the bounce size was only about 38.2%, not the best bounce right now. And now we have unfortunately recaptured the daily downtrend to the bears. So only a few lines of defense left for the bulls right now, guys. And it all starts at this 200-day moving average around the 159 level. All of the big horizontal support is there as well. In the event, guys, we flush through this location and continue this weekly downtrend, we're coming up onto arguably one of the best supports in recent history. Prior all-time highs was a contested area here in the month of January too. If we pull back in this location, guys, it is a no-brainer buy for me on Google. That will be down from the all-time highs 20 to 25% for a company that is trading at a very, very, very attractive valuation. We haven't done it again since 180, but this PEG ratio should be roughly around the 1.2 level right now, 1.25 perhaps, which is an extremely attractive valuation for the company, right? Nothing has changed in the company's fundamentals since up here. It's just overall market rotation, right? The valuation is still very, very attractive, which is why I say low 160s is still an area which I want to trade it at because I do feel the maximum drawdown is only all the way down to here. So I'm playing it here currently, and I will play it down there some more. Hopefully that's helpful. Now moving into Meta. Meta up about 0.28% as well, and Meta just still struggling at the all-time highs right now, right? Clear as day, struggled, tried to break through these all-time highs 1, 2, 3, 4, and 5 times and could not get it done. So in the event, Meta has now lost the daily uptrend, and in the event they roll over into the daily downtrend, getting rejected from this resistance area once again, well, daily downtrend will be underway. Just be looking for a weekly higher low for possible further trend continuation. If we can maybe retest the lower $500 range, that's going to free up some short put options or some put credit spreads all the way down here in this location here. The only time I would start playing calls again on Meta, something like that, is if they really pull back harder, all the way back down to 475, 465, because then at least we have more recent, larger weekly support areas to really be basing our trade off of. So one of two things for call options on Meta for me: either we have to revisit this lower area because it gives us a better defined stop loss with our higher time frames, or the infamous breakout, retest the all-time highs. That is when I'm going to be going for some call options too, because then the stops can go right below here, and then we're targeting pretty much expansion all the way through 600. So Meta, not looking too bad right now, but definitely the bulls are struggling at the all-time highs. We'll keep an eye on this one day at a time. All right, now moving on to Microsoft. Microsoft about 0.61% here today. Not too bad at all for the company. But Microsoft at one point, guys, was up almost 2% before they gave it all back. So red candle on a green day for Microsoft. Very unfortunate for them. I was looking forward to their push attempt right back in this location. Unfortunately, just probably setting a lower high. Now, in the event that we roll over here, guys, and break 407.29, that would be daily downtrend confirmed for Microsoft, and we would just be looking for the extension of weekly consolidation. Keep an eye on the size of the bounce for Microsoft, guys. Microsoft as well, similar to Google, did not have the size of the bounce that some of their peers had. Only a 50% bounce. That is not the best. It gives the bulls a chance to be able to reset into a possible weekly uptrend, but it does not give them as best of a chance as if they possibly put in a 618 or a 782 move, get above this resistance, and then use it as support, right? This whole level right there. So right now, we're going to be counting on these lower bulls right here. 403 down about 395, which is also the area that I want to be selling options on Microsoft in. This is such a solid level of support here, guys, since all the way back in January, and the company's fundamentals are arguably better than they were back in the month of January right here. No problems at all for the business, no red flags. The company is the exact same company as they were at 470. So when we are down so significantly on Microsoft right now, 11%, and if we come all the way back down here, 14, 16%, screaming buy opportunity for me on Microsoft. So for some call option trades and long trades like that, probably looking for 405 or better. Going to try to be a little bit greedy, a little bit below this 200-day moving average. And for any short put plays or put credit spread plays, a lot of them are already open on a weekly basis right now. 395 down to about 385 is what I'm targeting. Moving on to Netflix right now. Netflix not looking too bad, 1.26% to the upside, really holding a very tight accumulation range at the tops, right? Very, very tight. This does look like a bull flag. We are consolidating arguably above our most recent area of resistance, which is now acting as slight support for the bulls above this 12 EMA as well. I would not be surprised if Netflix does just bull flag this and pushes on further. Same concept as Apple and the SPY, right? Consolidation at the top end of the move is the best case scenario for any bulls in this stock right now. And on the weekly as well, the weekly is looking very, very, very good. But in the event that we do fail this location, break these lows and end up in a daily downtrend, what are we looking for once again? Looking for a possible, just a higher low on the weekly for possible further trend continuation here, guys. That would look like a very good setup. If we come back down here, 653 to 633, I will be looking to pick up some Netflix to be able to ride it back into the all-time highs. This company looking very, very, very strong right now. Moving into NVIDIA right now. So NVIDIA down about 6.38, down a lot more than they opened this morning, guys. NVIDIA hesitated around a better part of the morning before really falling off a cliff at the 2 p.m. mark and then hesitating the rest of the day, right? Very, very strange day today as a whole. But we did fill pretty much most of the gap that was set pretty much in the after hours market right there. So that is at least a positive point for the company. Now we are coming up into a crucial level of support right down here, which is about the 114. Lose 114 and you lose some very, very critical prior weekly support for the company, right? And unfortunately right now, what are we going to be looking for here, guys? Looking for a weekly higher low for possible further trend continuation right now. But if we want to have high probabilities of that trend continuation, they need to put a stop right here, because if you give back too much of a move, guys, you know what ends up happening. The best case scenario is a tightening range. The worst case scenario, of course, is a rollover into a weekly downtrend. But NVIDIA can do this sometimes, right? NVIDIA can sometimes just consolidate in the markets for a very extended period of time, tightening range, and then eventually have some expansion when it catches up with its fundamentals. I think this is a problem right now, guys. And as I was saying pretty much in yesterday's video, the biggest problem with NVIDIA right now is itself. It is the victim of its own success, unfortunately for the company right now. It's just put up such high numbers in the past 2 years that anything under completely ridiculous earnings guidance is not going to move the needle that much, right? It gets incrementally more difficult to keep beating by 20%, 30% on the estimates, right? So now NVIDIA is coming into more normalized territory, which is why I say it's kind of the victim of its own success, right? So it's maybe going to need some time right now to grow into its valuation. I would not be opposed to seeing some longer form consolidation. If anything, it may just be healthy for this stock right now. We'll take it one day at a time, of course, but I'm more interested in playing NVIDIA down here, 105 all the way down to about 95. I think the valuation is better down there. And I also do believe that the support level is a little bit stronger than it is necessarily up here as well. So going to be looking for those levels at 2. Just keep in mind, guys, NVIDIA on the monthly has been overbought for so long. So a few more months of consolidation, guys, would do wonders for this valuation and for the price action too. Moving into Tesla right now, Tesla up about 0.26%. Not the greatest day for Tesla, but at least they weren't down 3-4%, right? So as a whole, right, this was a nice daily uptrend for Tesla. As you can see right here, daily uptrend. And unfortunately, we lost the daily uptrend now into a daily downtrend. So at that point, we know that we are in for weekly consolidation, right? We were looking for how high this move could get. And since it was a relatively muted bounce, if I can say the least, 50% is okay, but it's not a 618 and it's not a 786. But the fact here, guys, that we gave back, right? We gave back all of this pre-earnings run-up momentum after deliveries and after the robo-taxi announcement. At this point, in my humble opinion, guys, this is probably going to be dead money until they release their next deliveries or until they have their new robo-taxi event in the midpoint of October, right? There's really not many bullish catalysts yet for Tesla. I know we're getting rate cuts in September, but keep in mind, for rate cuts to actually stimulate demand for big ticket purchases such as cars, it's going to take a very long time, right? Financing rates on vehicles right now are between 7 to 8%. So let's say the Fed cuts interest rates by a whole percentage points by the end of the year, right? Well, those car financing rates still go to about 5-6%. A few years ago, they used to be 2%, right? 2.5%, still a bit expensive for most people out there. So I do believe that this one may just be relegated to, at best, a tightening range. at worst, a loss of the weekly uptrend into downtrend. I will be waiting to play this one a bit more aggressively down here, but for the time being, it's kind of just in the middle, kind of in no man's land right here. So I need to wait for some better prices. I'd probably be targeting roughly, 180 and below to really be safe for writing options. And now lastly, Palantir, guys. Palantir also with a fairly decent day, up about 2.11% on the day, but giving back a lot of those gains. As you can see right here, Palantir at one point was up over 4.5% before retracing. So at this point, guys, one of two things is possible. Either this was the daily high or low, and we are going to go for the continuation of the trend expansion, which could take us possibly into the $35, $36 level, which is very close to the all-time highs. However, I don't really like the shape of this daily candle. In the event we were to break yesterday's lows here, guys, that would be your lower high is set, lower low, daily downtrend, and then we know that weekly consolidation is possibly further in motion at that point. Where are we looking for weekly consolidation here, guys, right? Probably looking for the $29 to $28. That is the area that we recently broke out of, but it was huge resistance back in 2020 and 2021. So possibly just looking for a retest of that zone, which would maybe free up some strikes if we're selling options all the way down here, $27 to about $26. I like that level. And there may even be an opportunity for a cheeky long with a relatively tight stop loss. If we do pull down into this location, right, we set some lows, have a nice bounce and try something like this formation, well, then at least we have some shorter term stop loss levels to be basing our trades off of for that potential current rally continuation, right? So Palantir, not looking the worst, but I'm still staying a bit more patient on this one. So that's pretty much everything, guys, that we had in today's video. Hopefully you enjoyed that. Tomorrow, pretty much, we only have the PCE inflation report. I do not think that it's going to be moving the market so much over the course of the day tomorrow. A couple more things such as personal income and personal spending. I don't think that those will move the needle that much either, unless they're really, really, really terrible. These have kind of been down, well, rather, not personal income, but personal spending has been ever so slightly retracing and contracting over the last 5-6 months. We know the trend is there, so I'm not really expecting any large market moving events from there, but we will just see how tomorrow happens. And tomorrow, of course, guys, we have a half day because it's going to be a long weekend for the markets as a whole. So hopefully you guys are able to enjoy the shorter form half day tomorrow. If you enjoyed the video, guys, consider dropping a like. Would really appreciate it for the growth of the channel. Also, consider subscribing to the channel if you're new. Would love to have you back here. We do these videos every Monday to Friday after the close. And as usual, guys, if you have any questions at all, feel free to leave them down below in the comments, whether you want me to look at a stock, some technical analysis, maybe an options play that you want a second opinion on, maybe some macro discussion about the economy, anything you want, guys. I am all ears and I usually answer you back in the next 24 hours. And of course, as per usual, guys, if you want to join our private Discord and trade with me live in the mornings, Monday through Friday for our private market live streams, have all of my trades all throughout the day live, have exclusive content, and be in the chat room all day, every day with us, guys, definitely feel free to click that link down below in the description for more details on that Discord service. So take care, guys. I'll see you tomorrow after the close, and peace.